The global financial system has revolved around the United States dollar. It has functioned as the world's primary reserve currency, the backbone of international trade, and the ultimate safe haven during times of crisis. This position has given the United States unmatched economic influence, allowing it to borrow cheaply, finance large deficits, and project power far beyond its borders. However, recent developments involving China's handling of U.S. government debt have revived an old and uncomfortable question. Can a reserve currency lose its dominance, and if so, how does that process begin? This report examines the growing narrative that China's recent reduction of U.S. Treasury holdings reflects a deliberate strategy rather than a routine financial adjustment. Supporters of this view argue that history provides a clear warning, pointing to the collapse of Britain's financial supremacy in the early 20th century as a cautionary parallel. The modern financial order depends heavily on confidence. Nations hold dollars because they trust the stability of the U.S. economy, its political institutions, and its debt markets. This trust allows the United States to issue government bonds that are widely accepted as low-risk assets. Over time, this arrangement has become self-reinforcing. The more the world relies on the dollar, the stronger its position appears. Yet reserve currency status is not guaranteed forever. History shows that it depends on underlying economic strength, fiscal discipline, and international confidence. When these foundations weaken, even the most dominant currency can face long-term erosion. China has long been one of the most important foreign holders of U.S. government debt. For many years, this relationship symbolized the deep financial interdependence between the two largest economies in the world. U.S. bonds offered China a place to store reserves, while America benefited from steady foreign demand for its debt. In recent years, however, China has gradually shifted its approach. Instead of maintaining or increasing its exposure to U.S. debt, it has moved toward reducing reliance on dollar-based assets. While this shift is often described as diversification, some analysts argue that the scale and timing suggest something more deliberate. According to this interpretation, China is no longer simply managing reserves. Instead, it may be repositioning itself in anticipation of structural weaknesses within the U.S. financial system. Those who view China's actions as strategic argue that selling U.S. government debt sends a powerful signal. Government bonds are built on confidence. When a major holder reduces exposure, it raises questions in global markets about long-term stability. From this perspective, the action is not about short-term profit or routine rebalancing. It is about applying pressure where it matters most: trust in U.S. debt and, by extension, trust in the dollar itself. As confidence weakens, borrowing costs can rise, market volatility can increase, and the financial advantages enjoyed by the reserve currency issuer can slowly diminish. This form of pressure is often described as economic warfare, a conflict fought not with weapons, but with capital flows, balance sheets, and strategic timing. Supporters of this narrative frequently point to Britain's experience as a historical parallel. In the early 20th century, Britain occupied a role similar to that of the United States today. The pound sterling dominated global finance, and London stood at the center of international banking. However, Britain's position rested on fragile foundations. High debt burdens, trade imbalances, and rigid monetary commitments weakened its ability to respond to external pressure. As confidence faded and capital flowed outward, Britain was forced to abandon the monetary framework that had underpinned its dominance. The result was a sharp decline in global influence and the end of an era. The lesson drawn from this episode is that reserve currency status can unravel when economic realities no longer support financial ambition. Those who draw comparisons between Britain's past and America's present argue that similar vulnerabilities are emerging. Rising debt levels, political gridlock over fiscal policy, and increasing reliance on monetary expansion have raised concerns about long-term sustainability. In this interpretation, China's actions are seen as a calculated response to these vulnerabilities. Rather than waiting for a crisis, China may be acting early, reducing exposure while signaling skepticism about the future trajectory of U.S. finances. The argument suggests that such moves, when combined with broader global shifts, could gradually undermine the dollar's privileged position. Reserve currencies function on belief as much as economics. When major players adjust their behavior, others take notice. A slow erosion of confidence can lead to changes in how trade is settled, how reserves are held, and how risk is assessed. For ordinary citizens, these shifts are often invisible at first. Over time, however, they can influence inflation, purchasing power, and the real value of savings. Critics of the current system argue that these effects tend to emerge quietly, becoming obvious only after significant damage has already been done. History offers multiple examples of dominant financial powers losing their position. In many cases, the pattern is similar. Excessive debt, external pressure, and declining confidence combine to weaken the system from within. Rival powers do not need to destroy the system outright. They only need to expose its weaknesses. Viewed through this lens, China's actions are part of a longer historical pattern rather than an isolated event. The focus is not on immediate collapse, but on gradual transformation. For some, China's reduction of U.S. debt exposure is a clear warning, a signal that confidence in America's financial foundations is no longer unquestioned. For others, it remains a manageable challenge within a resilient system. What is clear is that reserve currency status is not permanent. History shows that it must be earned continuously, supported by economic discipline and global trust. Whether the United States can maintain that trust in the face of shifting global strategies remains one of the defining questions of the modern financial era.